Welcome to the deep dive. This is where we take the source material you send us and, well, we pull out the key insights you need, minus all the noise.
Exactly.
And this time, you gave us a really interesting set of documents, performance reviews, earnings presentations, even bits from an earnings call transcript.
All focused on ICICI Prudential Life Insurance and ICICI Lombard General Insurance.
Right, covering their performance for the last quarter and the full financial year that ended March 31st, 2025.
So our mission here is to give you a clear, concise rundown.
Yeah, help you understand their performance, their strategies, maybe where things are heading without, drowning in spreadsheets. Okay, let's get into it.
Well, right off the bat, what's interesting is you see two slightly different stories, but they fit together. ICICI Pru Life seems to have had a year of, let's say, significant growth, while ICICI Lombard General looks more like steady performance, maybe focusing on solidifying their position.
Okay, so let's start with ICI Prudential Life then. The profit growth you mentioned, that really stood out to me too. Their profit after tax, the PAT, it jumped nearly 40% to almost euro 11.9 billion.
Yeah, 39.6% year on year. That's a strong number.
It feels like a pretty healthy sign, doesn't it?
Absolutely. I mean, a jump like that for a big player, it usually means they're getting a few things right. Could be cost control, could be selling more profitable products, maybe grabbing market share.
We'll have to see what played the biggest part going forward, I guess.
Exactly. And this profitability, it's backed up by their value of new business, their VNB. That hit 23.7 lire billion.
Right, and the VNB margin was 22.8%. Now, the report did note that margin moved a bit compared to last year.
It did.
Said it was mainly because of a shift in their, quote, new business profile and some changes in assumptions, so it's not quite apples to apples, is it?
That's a really good point. A shift in the business profile, well, that could just mean they're selling, say, more protection plans compared to investment-linked ones, or vice versa.
And different products have different profit levels, right?
Exactly. Different profitability, different capital needs. So that affects the overall margin. And changing assumptions, things like mortality expectations, that directly impacts how much future profit they think is locked into that new business.
Okay, that makes sense. We also saw their total premium was up, about 13.2%, hitting almost 49,000 crore.
And their annualized premium equivalent, APE, that grew by a solid 15% to over 10,400 crore.
Those numbers really show they're bringing in business, both new and recurring.
They do. It points to good momentum. And it's not just sales. They're managing their existing money pretty well, too. Assets under management, AUM, up to euro 3.09 lakh crore.
That was a 5.2% increase year on year.
And the embedded value, EV, which is basically the present value of future profits, plus shareholder net worth, that jumped 13.3% to about 479.5 billion.
That's a significant jump in EV.
It is. And what's really quite striking is if you look back 5 years, both their EV and AUM have grown at an average rate, a CAGR of over 15% per year.
Wow, over 15% average for 5 years. That's consistent strength.
It really speaks to a robust long-term growth path.
So what usually drives that kind of sustained growth in EV and AUM for a life insurer?
Well, typically it's a mix. You need strong, profitable new business sales year after year. You need to manage your expenses effectively. You need decent investment returns on the money you hold. And crucially, good persistency.
Meaning people keep paying their premiums.
Exactly. It looks like ICICI Pru is probably ticking most of those boxes. Now, thinking about how they're getting that business, their distribution channels are key.
Yes, the report mentioned their own channels. The agency force and direct sales are becoming more important.
Right. Those proprietary channels grew by a combined 15.2% in FY25.
And they now make up over half their retail APE. What does that shift towards their own channels tell us?
Well, relying more on your own channels usually means more control. Better control over the customer experience, the brand message, and potentially higher profit margins compared to using third parties.
So they're investing in their own sales teams.
Seems like it, and successfully scaling them. But looking at the full breakdown for FY25, agency was 28.9%, direct was 14.4%, bank assurance selling through banks, that's still huge at 29.4%.
Okay, so still a big chunk.
Yeah. Partnership distribution was about 11%, and group business was 16.4%. So yes, proprietary is growing, but it's still a diversified mix.
A balanced approach then. Beyond the financials, the review also talked a lot about customer focus, which is just so critical in insurance, isn't it? Trust and reliability.
Couldn't agree more. And their numbers look good there. Claim settlement ratio, 99.3% for FY25.
That's industry-leading, right?
It is. And they're paying out non-investigated death claims in just 1.2 days on average. Think about that. In a really tough time for a family, that speed matters.
Absolutely. It builds huge trust.
And their persistency is strong, too. 89.1% of people are still tenants after 13 months. That suggests customers are happy, they see the value.
And they were ranked #1 in some customer experience NPS study for the 3rd year running.
Yeah, that's strong external proof of their service quality.
That customer focus definitely seems like a core part of their strategy. They also mentioned this ICICI PruStack platform. What's that about? How does it help?
Yeah, ICICI PruStack. It sounds like a big tech investment aimed at making things better for both customers and their distributors.
How so?
Well, better tools for distributors mean they can give better, more tailored advice. That could lead to happier customers, better persistency, like we just talked about.
Okay.
And for customers, it probably means smoother processes, easier to understand your policy, easier to interact with the company online.
Like, they're using tech to cut down friction. They also flagged simplification about 76% of policies using digital KYC.
And nearly half their savings policies issued the same day in FY25.
That's fast. Cuts out a lot of waiting and paperwork for the customer.
Definitely. And it's good to see they also emphasize risk and prudence. They talked about a strong solvency ratio.
Which is their buffer against unexpected losses.
Exactly. Shows they can meet their promises to policyholders. They're also constantly monitoring persistency, mortality experience, and using derivatives, complex financial tools, to manage interest rate risks on certain products.
Like their guaranteed savings plans.
Precisely. That kind of proactive risk management is vital for long-term stability in this business.
They're also doing things on the ESG front: environmental, social, governance, reducing paper, using green energy.
And social stuff, too. Microinsurance covering over 73 million lives, apparently. And job training for underprivileged youth.
It shows a commitment beyond just the bottom line, which is increasingly important.
It is. For investors, customers, everyone, really. Now, stepping back, the report also paints a picture of the huge opportunity in the Indian life insurance market itself.
Right. They point out that insurance penetration, especially for protection, is still quite low compared to other countries.
Plus, you've got rising incomes, a massive and growing population.
And a big gap in retirement planning. It feels like a sector with a lot of runway left.
It does. And they included a sensitivity analysis, which is interesting. It shows how changes in key assumptions affect their VNB and EV.
Like what?
For example, if people live 10% longer or are 10% healthier than expected, their VNB could go up by 3.6 billion rupees and EV by 2.3 billion.
Because they collect premiums longer or pay out less on health claims.
Sort of. It affects the expected future cash flows. But conversely, if their costs to get new customers go up by 10%, VNB could drop by 3.9 billion.
So it really shows the key levers and risks.
Exactly. It highlights what really drives their numbers.
They also mentioned some new product features, an increasing annuity option, first in the industry apparently, and a premium break feature. Sounds like they're trying to innovate.
Got to stay competitive, right? Offering flexibility. And we saw a big growth in the new business sum, assured the total amount of cover they sold, up 16.9% overall.
And even higher for retail customers.
Yeah, retail new business sum assured jumped 37%. Shows strong demand for protection from individuals.
Interestingly, their total investment income was down slightly.
But income from non-unit linked investments, so interest, rent, dividends, that actually went up.
Okay. And commission expenses rose.
Yes, but they tie that directly to the growth in new business. Basically, you spend more to get more sales. Seems like a strategic cost of growth.
Makes sense. Invest now for future returns.
And finally, just a technical note, they use standard actuarial practices, APS 10, for calculating that embedded value. Ensures transparency and consistency.
Okay, so a really strong year for ICICI Prudential Life overall. Growth, customer focus, strategic moves. Now let's switch gears. ICICI Lombard General Insurance. What were the main takeaways there?
Right. For ICICI Lombard, the focus in the documents you sent was more on the audited results for the quarter and the full year ended March 31st, 2025.
Okay.
The board approved the results, and they recommended a final dividend, 7.0 per share.
That's 70% of the face value. A decent dividend signals confidence, usually.
Generally, yes. Confidence in profitability and a commitment to shareholder returns.
They also mentioned appointing a new secretarial auditor, Perrick & Associates, for 5 years starting FY26. Standard governance stuff, but important.
Absolutely. Keeps things transparent. Now, looking at the summary financials, for the full year, FY25, net earned premium was 17,477 crore,
Okay.
and profit after tax came in at 1,682 crore.
So, solid numbers. The summary didn't give a direct comparison to last year, though.
Not in the snippet provided, no. But those figures give you a sense of their scale and profitability in the general insurance space.
Right. A picture of steady financial health. Did the sources give any color on how specific parts of the business did, like motor versus health or fire insurance? Any standout segments or challenges?
The summarized income statement was quite high level. You'd really need the more detailed segment reporting to see, which lines drove growth or faced pressure. But the overall profit suggests things were generally stable across the board.
Got it. Also good to see they reported 0 pending shareholder complaints for the last quarter.
Yeah, that's always a positive sign for investor relations.
Yeah.
And one final point on Lombard. The auditors, PKF, Sridhar and Santhanam and Walker Chandiok & Co., they issued an unmodified opinion.
Which means?
It basically means a clean bill of health on the financial statements. The auditors didn't find any major issues or misstatements. Adds confidence in the numbers.
Okay. So maybe not the same explosive growth as the life side, but ICI Lombard looks stable, profitable, and focused on shareholder returns.
That seems like a fair summary based on these documents.
All right, now let's shift to those earnings call snippets. These were mainly from ICICI Bank's call, but some interesting points came up, right?
Yeah, they offer some broader context. One discussion was about savings rates and repo rates. Management basically said, look, there's no direct automatic link.
So the central bank cuts rates, but savings account rates don't necessarily follow step for step.
Exactly. They emphasize that banks figure out their own optimal savings rates based on their funding needs and what the market's doing. It's not just a formula.
That's important context. What else?
They talked about exceptionally good loan growth in business banking. And management sounded pretty comfortable with the risk levels there. And in corporate banking, too.
Okay.
Secured retail loans were also doing well, apparently. And they felt the issues in unsecured retail loans, like new NPLs forming, have pretty much stabilized.
So a generally positive view on asset quality across the board.
That was the message, yeah. It's always crucial to hear how banks feel about loan risk, especially when certain segments are growing fast.
Definitely.
There was also a question about why their risk-weighted assets, RWA, grew faster than overall loans.
Right. What was the explanation there?
Two main reasons. One, the mix of loans shifted towards categories that naturally carry a higher risk weighting for capital purposes.
Okay.
And two, they had higher market risk at year-end because the interest rate environment made taking certain trading positions attractive.
So it wasn't necessarily about higher credit risk in the loans themselves.
Not primarily, according to them. It was more about the loan mix and seizing market opportunities, which then impacts the RWA calculation.
Got it. That makes sense. What about deposits? CASA ratio was flat?
Yeah, pretty stable.
Hmm.
Even though the RBI was providing plenty of liquidity, management explained that good organic growth in retail deposits basically balanced out outflows from wholesale deposits, which they were consciously trying to reduce anyway.
So a strategic move towards more stable retail funding.
Seems like it. That's generally seen as more reliable and cheaper for banks.
They also touched on vehicle loan growth slowing down.
They did. They put it down mainly to underlying demand shifts in the auto market, maybe some marginal pricing factors.
But not because they were worried about asset quality in that book.
Explicitly not, no. They reassured on that front. Said it was market dynamics, not credit concerns.
Good to have that clarification. And one last point from the call, cost of deposits was a bit higher.
Yeah, in the recent quarter, they said it was partly just because the quarter had more days than the previous one.
A technical factor.
And partly due to that slight dip in the CASA ratio we mentioned. Less low-cost CASA means a slightly higher average cost.
Okay. And someone asked about loan against property, LAP, in the mix.
They did. Management didn't give a specific number, but called it a reasonable component.
Right. And finally, just a practical point, an analyst suggested maybe moving the earnings call time.
Yeah, to avoid clashes with other big bank calls, just highlights how busy earnings season gets for analysts and investors tracking the sector.
A very practical suggestion. Okay, so let's try and wrap this up. Quick recap. ICICI Prudential Life showed really strong FY25 results. Big growth in profits, new business value, embedded value.
Driven by, it seems, good sales, customer focus backed by tech like the Pru stack, and a diverse channel mix.
Right. Then ICICI Lombard General Insurance, more a story of steady performance, solid profits, shareholder returns via dividends, and clean audits, operating in its own market dynamics.
And the earnings call snippets gave us some wider context on ICICI Bank's view of loan quality, funding strategy, and responses to market conditions.
So overall, this deep dive should give our listeners a much clearer picture of these two insurance giants.
Hopefully, yes. A
Yeah,
good handle on their recent performance and strategies.
absolutely. And if you do want to dig even deeper, well, you could look into how that ICICI Pru stack is actually being adopted, or maybe track those RWA growth drivers for ICICI Bank more closely.
Or look for more detailed segment results from ICICI Lombard when they become public.
Exactly. Which leads to a final thought, perhaps. Given everything we've seen, the growth, the strategies, the market context.
How might the bigger picture, things like the economy, interest rate changes, and obviously intense competition in insurance, how might that shape where these companies go next?
Yeah, and what do the trends and their results tell us about the broader Indian financial services scene? Something to ponder.